In this webinar, we cover distributions from inherited IRAs. Inherited IRAs. There have been a lot of changes in the last couple of years with inherited IRAs. What I'm telling you right now is what the law is right now. It might change in 6 months. It might change next year. But as I'm recording this video, this is what the law is right now. Anyone can inherit an IRA, but inherited IRAs are subject to special rules. Following the death of an IRA owner, the IRA usually passes to a beneficiary, right? So if the IRA owner dies, that IRA is going to pass to someone else. Required minimum distributions generally apply once an IRA account owner dies. This applies to both Roth and traditional IRAs. Roths don't require RMDs while the owner is alive, but once they die, then that IRA account is going to pass to someone else. And generally, that beneficiary or that heir, whoever inherits that IRA, is going to be required to take RMDs. The rules are different based on the type of beneficiary that it is. Okay, and I'm going to go over that in this webinar. Before the Secure Act 1.0, beneficiaries of inherited IRAs could choose a lump sum withdrawal or stretch the withdrawal of required minimum distributions over their life expectancy. Sometimes you would have somebody who would inherit an IRA that was really valuable. Like the IRA would have $500,000 in it or $1 million in it sometimes. And then the beneficiary might be someone young, like maybe a person dies and they only have an heir that's a grandchild, and that grandchild is only like 19. They could choose to stretch the withdrawal of the required minimum distributions over their life expectancy in order not to spend down that IRA. They were allowed to do that. The Secure Act 1.0 abolished stretch IRAs for most non-spousal beneficiaries. In most cases, the inherited IRA must now be fully distributed to the beneficiary within 10 years after the original owner passes away. When the Secure Act 1.0 was passed, it was believed that the 10-year rule did not require annual RMDs as long as the entire account was distributed before the end of the 10-year term. When the Secure Act was passed, it was commonly believed in accounting circles that if you wanted to leave the money in the IRA and allow it to continue to grow, you could do that. However, the IRS issued proposed regulations that beneficiaries subject to the 10-year rule also would be subject to RMDs for years 1 through 9 if the beneficiary inherited the account from someone who had already begun taking their RMDs. So for example, if someone passes away and they're already taking RMDs when they pass away, let's say they're 75 and they pass away, and they've already been taking RMDs from their traditional IRA, then the IRS has stated in their proposed regulations that the beneficiary has to take RMDs too. However, this caused huge confusion in the accounting world. Accountants were screaming. We were screaming because these are just proposed regulations, and the IRS took so long to come out with these. They were like, how are you coming out with these proposed regulations now, years later, where it's too late to even correct the issue if you had someone inherit an IRA back in 2022 or 2021. So, due to the confusion created by these proposed regulations, the Internal Revenue Service issued transition relief in Notice 2022-53. The year that they issued the notice is that first number in the notice. So they issued Notice 2022-53, and then in 2023, they issued Notice 2023-54, waiving the penalty for 2021, for 2022, and for 2023 for RMD failures committed by designated beneficiaries. It's like, yeah, thanks IRS. Thanks for coming out with guidance like 3 years late. And we don't have any guidance yet for 2024. I expect that it'll be forthcoming, but you never know. You never know. But in the meantime, the IRS has waived penalties for 2021, 2022, and 2023 if you did happen to have a person who inherited an IRA from a decedent, from a deceased person, where that person was already taking RMDs when they died. With regards to inherited IRAs, if the original owner has died and the IRA is passing to a beneficiary, all of the amounts must be distributed from the inherited account
by the end of the 10th year following the year of the original owner's death. This is for most beneficiaries. If a beneficiary does not distribute the balance of the account by the 10th year following the year of death, an excise tax will apply to any amount left in the account that is not distributed. Most beneficiaries have 10 years to distribute the balance of the accounts. Under the Secure Act 1.0, there are two classifications of designated beneficiaries for an IRA. The Act distinguishes between eligible designated beneficiaries, which are also shortened to EDBs. I don't know where the IRS has to shorten everything, but eligible designated beneficiaries and other. Other is everybody else that's not on this list. Okay, so this list is eligible designated beneficiaries. Everybody else is other. They're in a different bucket. Okay, all right. An eligible designated beneficiary includes a surviving spouse, a disabled or chronically ill individual, a minor child of the IRA owner, but not a grandchild. It has to be a minor child of the IRA owner. Grandchild doesn't count. Or an individual who is not more than 10 years younger than the account owner. Now, the rules for these are going to be different depending on what kind of beneficiary it is. Surviving spouses get the most flexibility. They're allowed the most choices with regards to an inherited IRA. If their spouse dies, then they get the most choices with what they can do with the money. Surviving spouses have the same options they had before the Secure Act 1.0. A surviving spouse can elect to treat the IRA as their own by changing the ownership designation or rolling over the IRA balance into their own IRA account if they wish. A surviving spouse can also choose to take distributions over their own life expectancy if desired. They could do all of these things. For example, I have an IRA, and let's say I pass away. My husband inherits the IRA. He can choose to change the name on my IRA to his name. He can choose to take all of the funds in my IRA and roll it over into his IRA. And he can also choose to treat it as an inherited IRA and take distributions over his own life expectancy if he wishes, if he wants to. He doesn't have to, but he can. He gets the most choices if it's a spousal beneficiary and the IRA is passing to a spouse. Example, Abel, age 73, and Betty, age 61, are married. Both spouses have traditional IRA accounts. On February 1st, Abel dies and his wife inherits his IRA account. Rather than take a distribution from her late husband's account, Betty decides to do a spousal rollover of the entire account balance into her own IRA. She's allowed to do this. She doesn't have to take required minimum distributions because she's only 61. And she could just roll over the entire account or the entire balance into her own IRA and not touch it at all. The rollover is not a taxable event, and Betty is not required to take any minimum distributions from the account until she reaches the required age for her own RMDs. Other eligible designated beneficiaries. Other eligible designated beneficiaries, the other ones on that list underneath the surviving spouse, they can take their distributions over their own life expectancy. However, with regards to minor children, they must still take the remaining distributions within 10 years after reaching the age of majority. And let me give you an example. Angie is age 50 and widowed, so she doesn't have a surviving spouse. She's widowed. On March 1st, Angie dies. She has one son, Thomas, who is age 15 years old. Thomas inherits his deceased mother's IRA. Thomas is a minor. He's only 15, so he's an eligible designated beneficiary. His 10-year payout clock starts when he turns 18 years of age. He does not have to take any distributions from the inherited IRA now. He can choose to wait and allow the funds in the account to grow. If he does choose to take distributions, the amounts will be subject to income tax because they would have been subject to income tax for his mother. It's a traditional IRA, not a Roth. So they would have been subject to income tax for his mother if she had lived and pulled the money out herself. So they're going to be subject to income tax when he does start taking distributions, but he will not be subject to an early withdrawal penalty regardless of his age because it's an inherited IRA. So there's never an early withdrawal penalty when it's an inherited IRA. This is regardless of the age of the beneficiary because it's inherited. The original owner died, but the amounts are still going to be subject to income tax if it's a traditional IRA. Any other beneficiaries. Now these are people who are not eligible beneficiaries. This is other, anybody else. For any other beneficiaries, the account balance must generally be fully distributed by the 10-year period after the death of the IRA owner. Example, Crystal, who was unmarried and had no children, died on May 30th. At the time of her death, Crystal had a traditional IRA worth $200,000. The beneficiary of our IRA is her brother, Rudy, who is age 42. Rudy is not disabled. Rudy can choose to distribute the IRA as a lump sum, so he can certainly do that. He can take it all in the year that he actually inherits the IRA, or he has 10 years to distribute the balance and pay the tax. No matter what type of distribution he chooses, the amounts he withdraws from the inherited IRA will be subject to income tax. However, the 10% early withdrawal penalty is waived for a beneficiary of an IRA when the original owner has died, and this is regardless of how old the beneficiary is. So he can pull the money out as a lump sum, or he can pull it out over 10 years, but he has to distribute the balance within 10 years after his sister passed away, within 10 years after her year of death.
The next webinar covers prohibited transactions.